Hello and welcome to Sectors Up Close. I'm David Pollard. Today we're looking at the US energy market and my guest is John Stoltzfus, Chief Investment Strategist at Oppenheimer Asset Management. You could say it's a classic supply versus demand conundrum. Demand looks good for US energy, with the EIA tipping a record year for US oil production. And with gasoline prices at their highest this year, that means big returns for majors and for refiners. Supply is more complex. US drilling rigs were down to 659 in the latest figures. That's the lowest since March of 2022. And uncertain energy prices, plus an emphasis on investor returns and fears that shale productivity is diminishing, has meant less and less investment in new production. For oilfield services companies, meanwhile, the Dallas Federal Reserve recently reported the weakest sentiment since the COVID pandemic. But there are opportunities too. For sector specialists, there's been a spike in oil and gas M&A deals. And among portfolio managers, there are those saying energy in, tech out, as they rotate to dividend yielders. All this against, of course, a major transition in the industry to new energy. Well, with me now is John Stoltzfus, Chief Investment Strategist at Oppenheimer Asset Management. John, many thanks for joining us. If we could start by looking at shale today. The big story there is the lack of investment in that particular subsector and the dwindling value of facilities and installations and so on. Does it mean that it's uninvestable?
I wouldn't say that it's uninvestable, but I think it's the oil industry's response in many ways to the administration that had taken a fairly hostile view early on after President Biden came to office on drilling in general. It appears now when we look at it, it's offshore drilling is what's in favor these days. But there is investment occurring within the energy industry, within the complex.
Well, another big story this year has been the drop in natural gas prices. They're down to about a third of where they were this time last year. But nonetheless, the US is set to be the largest LNG supplier in the world this year. That must present certain opportunities, doesn't it?
We can't help but think so, David. When we consider natural gas, it's the cleanest of the fossil-based fuels, and is very much able to bridge the gap in terms of the timeline between fossil fuel dependent society and a society that is much more on a broad basis dependent upon alternative energy. So we think that, a resting period in terms of pricing, and then the beginning of a rebuilding of pricing, not uncommon in markets that are highly dynamic.
Well, a similar question really for oilfield services companies. SLB, Baker Hughes and Halliburton all recently said that there was a slowdown in business in Q2, but are there prospects there too?
Well, we always look at, as intermediate to long-term investors, we usually consider these near-term pullbacks or reconsideration of the spaces within the energy complex. We see those as opportunity. And one thing, the complex equipment that is involved, whether it's in refining energy, maintaining pipelines, delivery services of all kinds, we have to think you really do want to participate in that space.
The other big story has been the halving virtually in profits at the majors because of fuel prices coming down. And for a different reason, Exxon today was rated by one analyst as a strong sell. That's because of the transition to new energy. What's your take on the majors at the moment?
One of the reasons why we like an approach that calls for individual equity selection along with owning the indices through an ETF is you can sort of offset the overweight that naturally comes in the weighted sectors like an S&P 500 energy, where about 40% of that sector is two of the major oil players. So you can offset a position in that with individual companies that might be involved specifically in drilling, exploration, marketing, et cetera. The majors are key in the transition from really practically major dependence upon fossil fuel generated fuel to eventually being an alternative based society. And we can't help but think that these integrated oils are likely to also be distributors of power generation in terms of charging automobiles. We don't think Elon Musk is going to hold the whole charging scene because, after all, the integrateds are well known for their gasoline stations across the world. And we think electronic charging would be another piece of business for them. They know how to distribute fuel to make the economy run.
Okay, so a complex sector, but with opportunities. John Stoltzfus, Chief Investment Strategist at Oppenheimer Asset Management, many thanks for sharing your thoughts today. And that is your roundup of the energy sector. I'm David Pollard, and this is Reuters.